Hi and good morning. It's Monday, 7th of May 2018. Welcome, like every business day, to Real-Time Daily Trading Ideas. We have 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screen, and maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick and smart, but for that daily, so let's have a nice start, like every day. We will start like every day with our risk disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits. If you're a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full risk disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything written down there. This is me. My name is Jens. I'm the German guy from Admiral Markets. My English is made in Germany. We are a big international broker with over 18 country offices, so I'm the Berlin guy. My English made in Germany, but hopefully some of my quality too. But I'm not the main speaker. The main speaker is the day trader of today. This is our scheme. On Monday, like today, it's Jay's day. On Tuesday, it's Paul's day. On Wednesday, it's Giancarlo's day. On Thursday, it's Inat's day. On a Friday, it's Dirk's day. Our leading day traders live every day to the same time. And of course, if you like to trade Forex and CFDs, you will get many benefits only with us. For example, typical spread of just 0.8 points with our bestseller DAX 30. Mini lots also for CFDs. If you like to trade with MT4, MT5, it's your choice, and great safeguards like our negative balance protection policy. Check all them out on admiralmarkets.com. There you will find also something about our regulatory background and how to contact us. You can call us, you can send us email, or visit the other channels like YouTube or Facebook. Usually all our webinars will be recorded and a couple of hours later available on YouTube. Enough from my side. Now it's time for Jay. Hi, good morning, Jay. Now let's rock the market.
Good morning, guys. Let me just switch the mic real quick. HD Pro webcam. That's not what we want. We want H2N. Can you hear me? Sound okay? Good morning, Yup.
Yeah.
Excellent. All right, let's rock and roll. It's another day, another dollar. Let me share my screen. Boom, boom, boom. Here we go. And we have a very nice week ahead of us. We still had a trade open long Euro Aussie, and it's a winner. We had 2 positions, long 77 and almost half pips plus 175 pips on the second half of the position. So that went well. And yes, it was carry negative. So we do have to keep that on the radar in case we go into a position. Do we make money or do we lose money while holding it for a few days? Strength versus weakness overnight. We can see technical bounce on the pound. There was no profit taking late into Friday London fix, 4 p.m. London time. That is a very bearish sign. Nevertheless, there could be a technical bounce. It's UK holiday today, so these guys are off, and the dollar index is performing well once more. Looking over, we're currently at 92.81. So the extreme buy side position is coming to a squeezing end, and the dollar is recoupling with rates. We waited for it almost 3 months, and now it's happening. So going against the dollar, do it at your own risk. We have quite a bit of interesting data. On Tuesday, tomorrow, we have retail sales out of Australia. That's expected to be a little bit bearish. Then we have Chinese data that's important. Inflation expectations, that's only 100 people getting interviewed. But nevertheless, it's rare that we get data out of New Zealand, so we'll keep an eye on that. Then we have Jay Powell, not Jay Medro, Jay Powell speaking on Tuesday, and we have the annual budget release out of Australia. We'll go into that in a sec. Wednesday, we have PPI, as we can see, lower than last time in terms of expectations, and we have core PPI also coming off a little bit. So that's the pricing that goes into the value chain. And then on Wednesday, we have RBNZ rate decision, excuse my French. And during the night, we have the presser, and we have the first testimonial by Governor Orr, new RBNZ governor. Also more towards that in a sec. We have PPI and CPI data, i.e. inflation data out of China. And as you can see here, what goes into the value chain, prices are increasing. What comes out of the value chain, prices to the consumers expected to not increase yet versus last time, but rest assured, increased prices into the value chain will be passed on, most of it at least, towards the consumer. Then we have Swissy and Euro bank holidays, nice for these guys. And then on Thursday, continued a slew of data. We have pound monetary policy decision. And last week, I don't know if you followed, I know my traders did, the weakening economic data out of the UK. And then last week we had Bank of England Governor Carney step towards the mic and goes, check, mic working? Yes, okay. Market, you got me wrong. Okay, this is monumental that a governor of a central bank steps towards the mic and says, market, you misunderstood me. That is as dovish as you can possibly get. I mean, that is maximum, how can I phrase it? It's so, I mean, it's been so long since we had that the communication between a central bank in the G10 and the market is perceived to be wrong by the governor, that he feels he needs to step into the mic. That wasn't even jawboning, that was hitting the pound right in the face. And accordingly, the pound sold off, which means to you that you sell any retracement. That was the name of the game last week. If you look at the chart, the pound was annihilated. Any level where the sell side was trying to step in and try to absorb with buy limits was overrun. It's something that in the seminar I tried to teach, and hopefully you guys watch this. Look at any level being completely overrun. So anyone out there saying that technical analysis is the key to all means and fundamentals and sentiment do not matter is horse crap. It's all about sentiment and fundamentals. And as I said, a central bank speaker hitting the mic saying, market, you got me wrong. That's ultra, ultra, ultra hawkish. So price increase, rate hike increase was above 80% about a month ago for this meeting right here, and it's in the single digits now. It was completely priced out of the market. That's what we call it, out of the market. Then we have CPI and core CPI in the US, and here you can see it's expected a little bit higher. So that's going to be of interest because we had non-farm payrolls on Friday. And the inflation component is watched by Jay Powell. More to that in the notes in a second. And then on Friday, we have the employment change and employment numbers out of Canada. And that's going to be important because we have a trade this week that involves the Canadian dollar. And then on Friday, we have Draghi, who is speaking, and University of Michigan consumer sentiment. Preliminary means it's a leading indicator for the US dollar. My computer is slow, I apologize. Tuesday, Powell's speech on monetary policy influences on global financial conditions and international capital flows. It's going to be closely followed. Why? Because non-farm on last Friday showed soft wage growth, and in the last speech, Powell said he's looking at wage growth not increasing significantly. And then during the Fed last week, they added the word symmetrical to their inflation target. That's significant. They hadn't put this in prior. So this is a new word, symmetrical in terms of the inflation target. The market interprets that as a temporary overshoot by inflation would be in order and accepted by the Fed. So that core inflation is currently moving closer to 2% target. They also changed that wording, moving closer to 2% target. And symmetrical implies that, hey, if we overshoot, please, Mr. Market, don't expect that we're going to go ballistic in terms of increasing the speed of our rate hikes. All Fed speakers so far that stepped towards the mic reiterated that it's going to be a pacing in terms of rate increases. Nevertheless, the market started to price in 4 rate hikes in 2018 and not only 3. And that's relevant on top of the extreme positioning of the dollar. And then on Wednesday, as alluded to, we have PPI coming in a little bit softer than expected and CPI coming a little bit better than last time. And this not 3 Q&Q increase takes our annual rate to 2.5 from 2.4. So the target is 2%. We have an overshoot here, and that is accepted by the Fed as based on the wording symmetrical. This is the highest level in terms of CPI since January 17. And the main reason here is higher energy prices. And if you look at the data in April, gasoline prices increased more than 6% in that month alone, which is double the seasonal norm. So what happens in a bank is that in the background, we have analysts and they run their own models, and they put these input variables into the models. And so it's no surprise to us that the CPI is expected to come in higher than last time, all right? Canadian dollar, we have employment data, so expected to come in a little bit less than last time. And last time, the increase was due to construction jobs and public administration jobs. And the unemployment rate is expected to stay unchanged. Now, The Bank of Canada has a labor market indicator called LMI, and that's improving a little bit to 6.4 over the past 6 months. And that is faster than the unemployment rates decline over that time. So their labor market index indicator is increasing at an increasing rate of change. Rate of change is quite important in anything that we measure in the economy or in the financial markets. If, for example, the rate of change of inflation expectations or real yields in the US would increase, that could really topple equities further. If the rate of change of inflation expectations and or nominal yields is real yields is improving at a moderate pace, the equities wouldn't be in danger to topple because economic growth is at a sustainable path. You see something similar in charts. You all know these parabolic charts shooting to the moon. We call it a J curve. We last had it in Bitcoin. If you now look at a Google chart, you see the same thing. Parabolic curves always, they're not sustainable, so they always break down eventually. And we all know what happened to Bitcoin. So rate of change in anything that you look at is quite important. Bank of Governor Poulos focuses on long-term unemployed, the long-term unemployed, and the young in the labor market, and the women in the labor market. And he thinks they could be attracted back into the labor force based on higher wages. So this is what the governor is looking at himself. He then assumes, if that were to happen, he assumes higher growth, economic growth, but without bad inflation, which then again would imply a slower pace of rate hikes. I know that there's a lot of ifs and whens, but this is the game that we're playing. Anything that the market you see in the chart now is what the market expects to take place in 6 to 18 months down the road at the highest probability. If something in the future assumptions changes, the price will change today. So there's millions and billions of dollars betting today on stuff happening in the future. It's quite abstract. It's not like you're manufacturing something and then you sell it on eBay or Amazon. Our game is all a mental game of chess. Pound. I need to wait for my computer. Here we go. Thursday official bank rate. They are expected to keep the rates unchanged. Then we have the bank rate votes, and this is where the focus will lie this time. We also have the inflation report and monetary policy summary. As I said in the introductory statements, we went from an above 80% probability of a rate hike about a month ago to below 10% now. Why? We had very weak economic data. We had soft PMIs, we had softer first quarter GDP growth, and we had softer CPI data. So anything and everything that came in was bad. And on top of that, we had Carney jawboning the pound. Very, very, very dismal situation for the currency. So now the market will focus on what we call the vote split. This is the 207, okay? If more votes are there to increase, that means the two would increase. That would imply confidence in the economic growth, but concern about inflation. But if Saunders and McCafferty, those are the two twos, if they would drop out, that would imply that the rate increase that we saw in November of last year was a one and done or one-off, that they're done. So if the two increases, then the market will start pricing in a higher probability for the July or August meeting to hike rates. If the two decreases goes to zero, that would be very, very difficult for the pound to rise. It would continue to sell off because that means they raised rates once and that's it. On top of all that, we have very difficult Brexit headlines that we need to deal with on a daily basis. I'm waiting for my computer. Hello. Thanks for your patience. Dude, this is unacceptable. Let's go. All right. Kiwi, Wednesday official cash rate, also expected to be left unchanged. Monetary policy and rate statements and presser. And then later that night, Governor Orr is to testify for the first time in front of the monetary policy, in front of the Finance and Expenditure Select Committee on his policy statement. The market expects a neutral stance on policy for now. Now, our job as currency traders is to always know when the next hike or drop in rates is expected to take place. And recall that the RBNZ's mandate since the last election was enlarged, and it's now including, similar to the Fed, an employment target. So these rate statements will be of more focus to the market participants going on out from here on out. And currently the market expects the next rate move for the second half of 2019, similar to the euro, where we expect the next rate hike in the third quarter of 2019 for now. So you always need to know, when is the next rate hike priced in? Something changes in terms of economic numbers, or someone like Carney steps in front of the mic and clearly communicates that the market and he or her are not in alignment. That has drastic consequences for the currency. Renminbi, we have the trade balance on Tuesday, and that's going to be focused on because of this trade spat between the US and China. Exports have performed really well year to date. We have a 13% year-on-year export growth out of China for the first quarter of this year, and this was the third best after Vietnam and Malaysia. So the consensus is for an 8% growth in April. So that indicates that there's some tapering of the strength according to ING. In terms of the trade dispute, last headlines were that the US asked China to lower its trade surplus by $200 billion by 2020. And then China proposed it would increase US goods imports, but lower tariffs on products, including cars. Gigantic car market over there. We have on the radar the May 12th deadline for Trump's Iran deal, meaning he will withdraw from the Iran deal and reimpose sanctions on Iran. This is one of the main drivers of oil currently. So WTI broke $70 to the upside, and it was the highest in more than 3 years in terms of pricing. Then we have the dollar strength that is pressuring emerging markets, and they will be continue to be followed intensely this week, because we saw EM stocks and EM currencies extend on their losses last week, especially Turkey and Argentina were hard hit. And then we need to keep on the radar Treasury refunding in the US. They're going to offer $73 billion of 3s, 10s, and 30-year new bonds this week, and that's $7 billion more than the equivalent round last quarter. So the question is, how will the market absorb this increased supply? And that will tell us something in terms of the potential continued sell-off in Treasury markets. Quite important, because dropping prices in treasuries means rising yields, means rising dollar, means more rising dollar, means problem for EM countries, etc., etc. Positioning: Aussie dollar, potential long signal; Canadian dollar, potential long signal; Swiss franc, potential long signal; pound, clearly short executed; New Zealand, clearly short executed; dollar, clearly long executed. Volatility: euro increasing, pound slightly off, yen slightly off, VIX slightly off. So new all-time highs, right? The FANG, the tech names, the FANG equities make up 27% of the index right now. So the recovery is over 40% based on the price increase of the FANG. And if you missed it, Apple rose significantly last week based on solely the fact that Warren Buffett in the last quarter purchased 74 million more shares. So that's called the 13D filing. Market keeps playing that game, looking at what Buffett bought, and then often the market goes into the same positioning, but at a later time. Option pricing for London session: short euro yen. Actually, that has some room to run. It's quite a good trade if you want to take a look at it and follow your own entry and exit signals. Option flows: bullish Canadian dollar and gold for Monday's session, the rest bearish. Interesting. Important picture: extreme positioning, buy side quite short in the dollar, and they're coming off their extreme short for a little bit, but that's just started to react. So we have some time there. That trade is expected to run a little bit longer. Potential trade for this week: I'm personally looking at short euro Canadian dollar. Why? We are seeing a softening in the economic momentum in Europe. Peak is probably in terms of momentum behind us. And then there's no tier 1 data expected this week, so it trades a little bit more technical. That's the expectation. Canadian dollar, we clearly have a significant demand environment in oil, whereas other arguments are speaking towards a short in oil. The demand environment is topping that for right now. On top of it, we have this week more headlines expected towards Trump and the Iran sanctions. Again, May 12th is the deadline. I expect oil to continue to strengthen for now, and that means due to the high correlation, Canadian dollar also seeing strengthening. Trade structure to limit sell orders in the market, show you the pick in a sec. Risk for the trade is that there are no sanctions or the deadline will get extended, and that would yield a potential drop off in oil and or a technical bounce in the euro because it's been trading quite weak recently. So here's a 1 hour chart, and we can see the support comes in here off of the daily chart. That's this gray area. And then we clearly had redistribution. My traders know what that means off of the top here. That's the top edge. So I'm trying to short towards the form of fair value and then top edge, and then let the trade run. That concludes Monday morning, May 7th meeting. Make a lot of pips this week. I hope you have a wonderful, wonderful week. The weather is great. Don't only trade, also go outside. Enjoy the weather a little bit. We only live once, and the charts will be here this week and next. That's why I always say trade smart, live free. Good trades here, good opportunities. Volatility is here. 2018, finally a year where we can make a lot of money trading again. Thanks for your attention, guys. I appreciate that you come in on a Monday morning. I love doing this for you guys. Thank you very much to you, Jens, as well. Have a great week. Bye.
Thank you, Jay. And tomorrow is another day. Tomorrow, a new day trader, a new trading style. So hope to see you again tomorrow. And yeah, great start into the week. Greetings from Berlin office. Bye-bye.